Good day, everybody. This is Paul Spirgel. You have stumbled into the week ahead in Forex trading, brought to you by Forexfolio with a major assist from FX Street. We're going to take a look at some of the data and sentiment coming up for the week ahead. And before we get started, as always, let's start with our disclaimer. Foreign exchange trading carries a high level of risk that may not be suitable for all investors. Leverage creates additional risk and loss exposure. Before you decide to trade foreign exchange, carefully consider your investment objectives, experience level, and risk tolerance. You could lose some or all of your initial investment. Do not invest money that you cannot afford to lose. Educate yourself on the risks associated with foreign exchange trading and seek advice from an independent financial or tax advisor if you have any questions. Any news, opinions, research, data, or other information contained within this presentation are provided as general market commentary and do not constitute investment advice. Forexfolio expressly disclaims any liability for any lost principal or profits without limitation, which may arise directly or indirectly from the use of or reliance on such information. Short version is be careful and responsible while you're trading. Let's take a quick look at some of the key economic data that's coming out this week. We've got interest rate announcements coming out of Canada. The UK has CPI and assorted other measures of economic health coming out globally. As far as Canada is concerned, the sentiment in the market now is still one of relative strength. Canada is borrowing from the perception that the U.S. is going strong, and Canada as a standalone is going strong. If the U.S. adds to that strength, it could only be good for the Canada down the road. UK CPI, the UK has a similar but completely opposite effect. The UK, obviously, their main trading partners are Europe. Europe, as we're all aware, is not doing particularly well these days. Thereby, Europe is actually creating a bit of a drag on the UK. And not that the English need any help in that area, but you know, for the short term right now, there is a pall over Europe, and you should be very wary of any rallies in anything going on in the Eurozone. And U.S. we have industrial production. The U.S. again, the perception is going gangbusters. We had a little hiccup last week with NFP. The numbers came in a little worse than expected, but the sentiment on a standalone basis is one of U.S. strength, and on a relative basis, considering what's going on with, to a lesser degree, China and to a larger degree, Europe, the U.S. seems to be the place to be these days. And by U.S., I mean U.S., Canada, Mexico to a degree, and even Brazil for that matter. Was Paul a big guy type of traders? I don't know what that means, but I could stand to shed a few pounds. But going on with the data ahead, again, Wednesday we've got the UK MPC minutes and the bank rate vote. It's key because it gives you a little idea into what to expect down the road. Again, in particular with what has been happening in Spain over the last couple of days, we don't expect any tightening going on anywhere near Europe, at least until 2013-14, where the U.S. has said it will be keeping rates low. So again, the ECB current account, you would expect, you know, ex-Germany, not to be much good news there, and UK unemployment, while it may make incremental gains, just like we are here, there just isn't a massive hiring up going on globally. And again, Thursday, Eurozone flash consumer confidence. I wouldn't expect much confidence going on. U.S. existing home sales, that's a key. As we've mentioned here several times, the story in the U.S. at this point is twofold. It's housing and it's employment. And until we can get those two wild cards moving in the right direction, we're going to have a lot of volatility in the U.S. and we're going to be going number to number. There just isn't any real consistency going on. That's you know, they sort of feed on each other. If you had home sales going up, the general notion in the U.S. is that that real estate and building drives the U.S. market. If that were to happen, then you would get more jobs and it would, further feed on itself. Right now we're in a vicious cycle, and we've got Europe thrown into the mix as well here on the U.S., so it's making for a lot of excess volatility. That's not good. On Friday, we have German PPI in Germany, the IFO business climate. For the Germans, they are the only good news coming out of that whole Eurozone. And unfortunately, it's going to be a drag down the road because, again, as we said with the UK, the Germans are going to need somebody to trade with. The Greeks have entered into austerity programs. The Italians and the Spanish are going austere. The Irish are. So, all this austerity means a lack of growth. A lack of growth, plainly defined, means that the countries that the Germans trade with the most are not going to be buying. Then we have the U.S., which is making good moves, but, again, with 8% plus unemployment, we're not, going out there buying with both hands. And the Chinese are slowing down a little. The Chinese are cutting rates and looking to stimulate their economy. So while the Germans are in good shape for now, you could expect that as the crisis wears on, they're not going to be they're not going to be inflating anytime soon and raising our rates. And same UK retail sales, they could be good, but there's nothing that's going to blow out. That's going to, I believe, run sterling up to 165 or even the euro, above 135.20 or so. So for now, keep an eye. If we get some good incremental growth, we could be all right. But in Europe, pay close attention to the Spanish bond auctions and to the German economy, because if the German economy starts to melt down a little bit, then you don't even have your major life preserver in that area. All right. Next. Again, as we've moved into a precarious state vis-a-vis the Spanish bond auctions, I thought it would be a good idea to keep an eye out on what is coming up in terms of bond auctions and rate announcements. So again, as you see on Tuesday, Spain has another $3.5 billion of auctions of bonds that they're looking to raise. The Greeks have $1.25 billion and the Belgians $6 billion. These are all relatively short-term obligations, so the effect on interest rates shouldn't be that big of a deal. I mean, we had some bad news today in Spain, which is what spooked the market initially. Keep an eye on it because it is a harbinger of things to come. And again, just the sheer volume, if you notice down the road, on Thursday, Spain has another $3 billion. It sounds like we're just throwing around billions here and there, like it's nothing. But these are significant amounts of money. The France issuance that's coming on Thursday also $10.5 billion. It's short-term paper, but they still need to get that kind of money. At a certain level, as we all know, whether you're in college or wherever, when you need cash, you need cash. So it doesn't matter if you're borrowing it for a week or for 10 years. If you keep going back and borrowing and borrowing and borrowing, it will have an effect on the entire curve. And again, interest rate-wise, we're not expecting much. Keep an eye on India. They're expected to cut rates 25 basis points, and India is moving up from its lows of 48.5 a couple of weeks ago. It's trying to make a move back to its 53.50 highs for the year. Cutting rates, as we've mentioned again several times, is not the way to strengthen your currency. So you could expect that the rupee will continue to lose a little steam vis-a-vis the dollar and start moving back towards that 52.53 level. Brazil also is expecting to cut rates. Brazil has been cutting rates. The strength of the real has not been helping them, and they're looking to they're looking to stimulate a little growth and at the same time knock out some of the strength of their currency. So those are the only two interest rate announcements that are going to have any change. And again, India may have some significance for some of the manufacturing that goes on there. And again, keep an eye on Spain in particular. they are the one that's giving the market the most cause for concern these days. All right. So we got important data releases in the U.S. and the Euro area next week. We had retail sales today. The revision from last month was a touch lower, and this month was essentially on target. We've got industrial production Tuesday and German IFO on Friday. Keep an eye on IFO again, because it will give you an idea of what's going on in Europe from a position of strength. Again, other central bank decisions are Sweden, Chile, Turkey, and the Philippines. We expect them to keep the rates on hold, and we've got the Reserve Bank of India tomorrow, which, as we said, we're expecting a 25 basis point cut. And for now, the focus remains on European banks, economies, and funding. And Spanish auctions were poorly received, and yields are backing up. Market convention is that if we get close to 7% in the Spanish 10-year, that is an area where the market expects that the European alphabet soup, the EFSF, the IMF, the ECB, all those guys are going to have to come in and add liquidity and just intervene in the market. So keep an eye on that. If you're out there playing in the bond space, you may not want to aggressively sell bonds as we're going through that area. And again, as a corollary to that, the safe haven trade in bonds is on. U.S. 10 years, German and Japanese 10 years have been rallying. German 10-year, again, Germany is part of the euro, but when you're looking at this crisis, and we've been looking at this crisis for a couple of months now, Germany itself and the euro to a degree, because Germany is such a large part of it, is not a proxy for the whole Europe. They are a separate entity, or they're viewed as a separate entity within Europe, and they are seen as the safe haven in Europe. So German bunds have been rallying to record levels. The French have a little more safety, but again, they're nowhere near as rock solid as the Germans. So those are the three immediate safe havens. And again, when we say U.S., Canada also has been seeing some safe haven buying as well. Let's go on to the next one. Again, sentiment-wise, which is always the key for now, the U.S. remains the leader in perceived economic growth. As far as global economies go, the U.S. and North America in particular are seen as the leaders of any nascent economic recovery. And with that being said, Bernanke has pledged to keep rates low till at least 2013, 2014. And again, he has been talking about no QE3, but that being said, the market is starting to perceive, Chairman Bernanke has come out repeatedly and said he wants to keep rates low till 2013-14. So while he may not be cutting rates, and again, a rate cut at this point from 0 to 25 basis points to where, or whatever stimulative effects he can go throughout the economy, be it reserve rate requirement, jockeying, or any other measures that he might have. The fact is, interest rates are going to be low in the U.S. for the next couple of years. We've discussed in the past that Fed Chairman Bernanke is a student of the Depression, and as a student of the Depression, the one revelation that he has talked about repeatedly that he has seen from the Depression in the 1930s in the U.S. is that the Fed raised rates too early, and he wants to send a message clearly that he does not intend to raise rates clearly. He's willing to risk a certain amount of inflation just to make sure that the work he's put in over the last 3-4 years doesn't go to waste by people thinking that, by an investor perception, that rates are going higher. So keep that in mind. We may not get quantitative easing, but the low interest rate environment remains here to stay. All right. Again, going back to the bond theme here, which I know this is FX Street, not Bond Street, but bonds are a big tell these days. And in recent bond auctions, the Chinese have been buying a larger amount of U.S. bonds. There was a fear around the end of the year last year that the Chinese were going to start buying European bonds and not so much the U.S. Again, as the Spanish situation worsens, the Chinese have no choice, and again, with the U.S. looking to be the leader economically, they've been buying U.S. government bonds with both hands. And I like to say here in our second bullet point, as for Spain, to a lesser degree Italy, the feeling is that should Spanish yields approach 6.75%, 7%, there would be swift intervention from the European authorities. All right, again, and since you mentioned the wobble, Europe has to be careful the wobble in Spain doesn't go on too long, as they can't afford Italy to be dragged too deeply into the crisis. Again, the main thing that the Europeans are looking for, and the reason that the LTRO2 went off well, is they're looking to flood liquidity. They're not looking for any contagion. They're not looking for the bad feeling in Spain to go to Italy and then to even go to the rest of the countries. And the reason that is the major holders of European sovereign debt are the European banks. So if there is a bad event that will happen within Europe, be it Italy, Spain, Portugal, France, wherever, it will have a deleterious and almost ruinous effect on all the banks within Europe. We mentioned when we were talking about the Greek bailout, that the Greek bailout wasn't necessarily a bailout of the people of Greece, but it was a bailout of the banks that were holders of Greek debt. And that should be the theme that you should remember. When we're looking at these countries going down, the countries can go down. It's not like Italy and Spain are going to disappear off the face of the earth. But if the banks that have lent all this money to them have to take large losses, that will have an effect for a very long time. So that's what the fear is. It's not the countries going under. Nobody thinks there's going to be an Atlantis-like effect where these societies are going to cease to exist. But the banks, as we know them now, will have very difficult problems. So try to remember, everybody talks about all these fears, but nobody really knows what the underlying factors are. It's a little bit like we had spoken a couple of weeks ago about gold. Why is it when gold rallies, the Aussie and the Canada, go higher? It's not that these are gold economies. It's that there is a lot of gold production going on in these economies. When the price of gold goes up, it makes it more economically feasible for these economies to get the gold out of the ground. That means more jobs. It means more economic output, because of it. It's not poof. There are underlying reasons, and it's important that you as investors who are investing in these economies understand what it is that the cause and effect will be on some of these events. It should help you make more educated decisions and not just, chasing what everybody else says. I hope some of the education is getting through. What else we have going on? We have a G20 week coming up. The G20 meeting of deputy ministers of finance will take place on Thursday. You could expect that because of the recent increase by the G20 or the Eurozone, the SF and ESM have increased their funding levels. So the non-EMU countries will probably will have an easier time directing their governments to contribute to the IMF. This is really directed at China. The global economic police are looking for the Chinese to really get involved and help bail out the world via the IMF. And the Chinese are loath to do it unless the Europeans are getting involved themselves. The Europeans making this funding, increasing the funding to $700 billion should take care of that. And for the rest of the week here in the U.S., we've got a lot of high-profile earnings. We've got a lot of bank earnings coming up. Bank of New York, Goldman Sachs, Citi released today. They had good earnings, and those should be they should have a good effect. But again, don't take the earnings at face value. As we've said repeatedly, the Fed has kept interest rates low. That's usually a boon for banks. They're able to keep their bad loans on the books, and whichever ones they have or that are paying off are contributing to P&L. But the key things to look at, like I say in my in the bullet point here is, keys to how the real economy is doing, and that would be spending and housing. So you're looking for less charge-offs in terms of bad loans due to housing. You're looking for better credit card spending or better spending in general by the customers of the banks. That would show that the economy is moving in the right direction, and that there's greater economic activity down the road. So that's a quick look at some of the news out there. And again, sentiment-wise, the U.S. is leading the way. Spain, keep an eye on, or Europe, keep an eye on Spain and the Spanish bond yields. Germany has IFO coming up. Keep cognizant of how the Germans are doing as a subset of Europe. And again, remember that the euro is not necessarily Europe. The euro does move a lot with Germany, unless we get some news that would really hurt Germany. Don't expect the euro to tumble very quickly soon. I think over time, as the Germans are going to have to take a more of a leadership role in bailing out Europe, that might actually hurt their prospects as a standalone nation within Europe, and that might take the euro lower. But again, look at things for what they are. If it was just about Europe collapsing, we'd be at 100 already. But again, the end of the world is not here quite yet. And on that note, if you have any questions, please fire them in. I will get up a chart here, and we will try and look at some specific currency pairs that everybody is interested in. China loosens daily trades on the yuan ahead of the IMF spring meeting, but what were the possible motives? Well, China is looking to again show that it's loosening the bands, it's allowing its currency to trade more freely. The U.S. still likes jawboning with China that they're managing their currency to the detriment of the U.S. and the rest of the world. So by loosening their bands, they're trying to show that they're allowing it to fluctuate in a more reasonable band. Again, the Chinese are they're a difficult partner to have for the global economies. There's not much trust, yet the Chinese seem to have all the money and all the liquidity now. So on the one hand, where all these economies would really just love to tell the Chinese, where to go, they need them because they are the world's checkbook at this point. What is direction bias on euro USD from fundamental data or noise or news? It looks to me that for now, or at least for today, for the early part of today, the move was, whatever news comes out, even if it is good news, if it's not blowout good news, the path of least resistance for the euro is lower. We got a move down today below 130, and from what I understand from my contacts in the market, there were large barriers, barrier options at 130. And what the barrier option is companies, governments, whoever, market participants will go out and buy a barrier option. In this particular case, that if 130 breaks, then they would either sell euros at 135 or they would buy euros at 125. This is just an example. This does not necessarily have to be what happened. But the idea being that once that trigger has been reached, they would get a gain. So there's a big tug of war around those numbers. The people who sold the option don't want to have to pay off on it, and the people who bought the option want to drive it through, even if just for a second, as long as they can get that print and everybody agrees that we've broken the 130 barrier. Then that's apparently what happened today. There was massive selling to get the euro below 130. Then retail sales came out, and they started buying it back up. So the today's trading action was classic, what they call option spoofy trading. Why not the ones you mentioned? It could be the ones I mentioned. When you put on these barrier options, they are they're tailor-made. You could you price them however you want them. I was just using those numbers to illustrate that. The idea being that if it really what a barrier option is, and I'm digressing a little from what the ethos of this webinar is supposed to be, but what a barrier option is, it's really just a bet that the market will go through a certain area. So if you have let's call it a one-touch option. So what you're saying is that if it touches 130, you may pay $300,000 for a 130 one-touch. If it touches 130, then you get $1 million. You've paid $250,000, so you get $750,000. So it's really just a bet. And the same thing with some of these other, funky or exotic options. They're really just bets that you lever up, and it gives you different, whatever parameter you might need. But today, what they had was a 130. And again, as you can see, let me get a daily on here. We'll get a 30-minute. As you can see, we just went through to 129.95. That was enough for a print to be put in, and then we were back off to the races, and they took it back higher. Again, for now, as we've said in the past, the greater range for the euro is this 133.70, and beyond that 134.80. Looking for a reverse above 135.20. But until then, I'm still a proponent of selling rallies in the euro, looking for 125, even down to 120. Let me see if I can get up my MetaTrader here in case these charts are not showing up. Let's see. All right. So that's the euro. Again, we're looking for in the euro the 133.80, 134.80 is big areas of resistance for today. Again, this 132 is held in. 132.20 area should be our immediate support. And like we said before, the market likes to fill gaps. So if we go through this last high here, 132.10.20 area, we could see the move all the way back up to 133.20 area. But again, I would like to be short. Again, once we short here, leave a 132.30 stop, 20.30 stop, and again, sell up here again, leaning on this 133.80 area as a good resistance area. What else? We haven't spoken about Euro Swiss much. We'll try to give that a look-see. And again, we're hanging in here pretty well. The market seems to want to test the resolve of the SMB at this 120 area. We had the one move down on a spoof about 10 days ago, but for the most part, the SMB came in and talked it back up above 120. That there is not a greater distance between 120 and where we are now gives me pause and says to me that the market is winning its battle. That being said, I know that inside the SMB they're sitting there and they are not happy with Euro Swiss where it is now. So I'm very I think now would be the right time if you had the opportunity to put on some of those barrier options. If you wanted to put a 122.50 6-month Euro Swiss call on, I think you'd probably do all right on that. Again, it looks like for now we're holding in 120, and it feels like Minister Jordan, because they've been so quiet, with the exception of that one event, they're getting ready to do something. But again, I don't know what's going on in the SMB. It's just my feeling as a trader. But that being said, I'd also keep some stops below at 119.60 just in case they get a resounding punch through. And some of the things that might get that through would be Iran. The euro problems haven't seemed to really knocked out Euro Swiss, but if the Iranians start lobbing missiles or shut down the Straits of Hormuz, that's the kind of event that could knock Euro Swiss below the peg. So keep an eye on that as well. Any other questions or any? Well, the option expired today. Options usually expire at 10 a.m. New York time, which is 3 p.m. London time. And the option trades do significantly affect the market. And the way that they affect the market is that even when the option is going on, there are usually significant delta hedging going on. So if you go out there and you buy a billion, say 135 euro calls, the company that's selling it to you is going to go out there now, and depending on what the delta is, what the delta really is, for layman's term, is it's the spot equivalent of that option. So a 135 call, if it had, say, what they would call a 30 delta, if you did a billion euros as the notional amount, the firm that you dealt with would then have a liability on their books for around 300 billion euros. So they would start buying those euros either straight away or leave orders, but at some point they're going to be buying some euros. So that's how options affect the market. Then when you get these barriers getting close and the sellers have not done all their hedging, they'll go in, they'll fight against it, or after the option expires, if that company, like we were saying today, they needed it to break 130. If they were buying, well, in this case, it looked like they actually wound up selling at 135, so they were actually buying them back all the way back up to 130, 180. So the options do have a very significant effect. In fact, over the last couple of years, more and more trading has been going on these esoteric options. So it is worth knowing what's going on. Yes, they expire at the London fix at 10 a.m. At 10 a.m. New York time. Cable, let's take a look. All right, cable is cable. I mean, it's what do you want to talk about cable? We got to get a break below 158 or a move above 160, 30, 40, and inside of that, we're pretty much sitting here in no man's land. Again, the UK, don't expect much out of the economy. Expect it to participate in the bad news and not the good news. The good news is really going to flow mostly to Germany, and there's for the most part at this point, unless we see or need some real significant safe haven buying out of the euro, the UK is just going to hover around. So again, for now, safe havens look like U.S. dollar, Canadian dollar, Japanese yen, Aussie, as long as China's playing ball, and then 6 or 7 down the list would be the UK. There's really, UK's really just an afterthought to Europe. Again, unless they can get their economy turned around, but they're in no better shape than anybody else at this point, and it's not going to get any better because, as we said, their major trading partner is Europe. All right, let's see what else we got. Our options weekly, semi-monthly. How do we find out what is going on? How you find out what is going on? There are options that trade on in Chicago on the futures exchanges, but for the most part, the real significant option data goes on over-the-counter exchanges, and there's a lot of rumor. There's nothing really. You'll read about it in the papers. If you read the Wall Street Journal, every now and again, some of the reporters will talk about some big option trades that have been putting on. If you read Bloomberg will sometimes give you some market talk about big options going on. But for now, there is no. It's an over-the-counter market, and there's a lot of storytelling with regard to options. And again, you don't know. People will tell you, "Oh, big option just went through." Well, big option just went through. That's great, but did they hedge everything? Didn't they hedge everything? So there's a lot of, you really have to be somewhat expert at reading through the minutia to know what's going on there. What other questions? And again, options could be whatever tenor. I mean, there were some firms in the heat of the crisis that were writing options or buying options just over the weekend or over a day. If you had big, you could do an option for whatever time you like. They go from overnight to 10 years. And if you're the right customer for the right bank, they'll even give you a 15, 20-year option. So again, it's an over-the-counter market, and you can get it for whatever time period or amount you want. Are you better reading the charts to see options influence? No, I mean what you could see is, again, it's a little bit like let's take a look in the equity world. Right now, Apple's trading at around $600 a share. Right, so if you've been long Apple from 300, if you're a prudent investor, you would buy some Apple puts maybe at 450 or 500 just to have some protection in there. If you look at a chart of Apple, it's just been a straight line up for the last 2-3 months. So I mean, can you look at some of these moves here and say these are option related? No, you can't. But when you get some of these very fast moves, particularly around 10 o'clock, those could be considered option type moves. But there's no way, again, until there's a bona fide exchange, and some of the Dodd-Frank talk out there is about, broadcasting or, notifying the market about when different options and different derivative instruments are going through. So it's out there. It's a significant force in the market. And again, it's just another one of those ways where some of the retail guys are in the dark, but you have to be cognizant of it. Even if you don't know what it is exactly, it's important that you know that it is out there and it could whip you around. Because again, looking at today's action, I mean, great. You're sitting here. We've been talking lower. We had our move. We were saying here for the last couple of weeks in these 133s, to sell, keep selling all the way down. You got your move, and again, we were also talking 129.80 as a good support level, which was the last launch pad that it took it higher. And we went down there. They got their move, and they took their profit and took it up higher. It's just the way that the market works, and you have to be aware of it. It may not be fair that you don't know what's going on, but the fact that you know that it could happen, which is why, again, you want to keep trailing losses. You want to keep, in this type of environment, you would like to have kept on selling all the way down if you could, and then keep trailing stops along the way. You've got to figure out your own best methodology to protecting your own assets. Let's see here, Sam. We'll see defensive and area and rebounds. Okay, appreciate some of the news feeds. Also the option rumors. All right, there you go. So, I mean, again, there are some of the news feeds on FXDD or Alpari. They'll give you some option talk. Dow Jones, I believe, gives you some option talk. It's on Bloomberg every now and again. You got to seek it out. I mean, just it's important that you act like a sponge and just soak up as much market information as you can. All right. Any other questions? I guess we usually take a look at gold as well. Let's get a look at gold here. It's certainly an interesting chart here for gold. 1620 to 1680 for the most part, and again, there's not much movement here. The market, and again, we were talking about gold for a while. It was tethered to interest rates. That seems to have dissipated. Today's action, again, with the Spanish rumors and the euro, starting to feel like it was going to collapse again. Gold got a bit of a bid, and then when the stock market started turning around, came off a touch. Gold, for the most part, is a very, very illiquid, and I mean, look at our moves here, right? Going back to this is February 28th. Inch up, get destroyed. These long bars. It's a very tricky market. gold. You got to be fast. You got to keep losses, stop losses in play. Gold's the kind of thing, again, like we were saying with the Apple business. You may want to keep some protective options if you get a good move up. I mean, we had this nice move up here, $100, but it's treacherous. You work hard to get these moves, and then I mean, look how many days it took to get this one move back. It's tricky. For the most part, I would say stay away from gold, but if you needed to do something, I would buy if you can above 17, 15, 20, leaning on this area right here. I'm looking to refill that. That would probably be something of Spanish yields hitting 7.5% on the 10-year. So silver is a bit of an also-ran. It's an industrial metal. It hasn't been doing much lately. I mean, it hasn't even had those the same spikes as gold has. Again, it's been trading for the most part between 29 and 33. I mean, here for the last month or so, 33.30 to 31.20, $2, and even beyond that, for the most part, we're talking 34 to 31. Again, like the economies of the world, it's not running away from anybody. Again, gold, you get those ridiculous moves. If you got the stomach for it, by all means get involved. But for the most part, what silver is telling you about the economy as well is we're not really going anywhere. And it's, play at your own risk for gold. But silver, you want to be a seller above 33 and a quarter, with a stop loss at 35 or so. It's the metals are tricky. Again, and what's tricky about the metals also is you have so many forces economically, government-wise, that are screwing around with our basic safe havens, right? Our two major safe havens have been gold and have been treasuries. The treasury market, it has nothing to do with safe haven anymore. With all this quantitative easing around the globe, you can't really trust that what's going on is going on for the right reasons. So while the government seems to be helping everybody by propping up all these markets, what they've actually done is they've just muddied up the waters to how we're really doing. So I'm not a huge fan of all this government intervention to begin with. And again, as a student of financial history, a lot of the relationships that once existed are not as trustworthy as they once were. I got nothing on copper, Sam. Sorry. I don't watch that one. I mean, I own a bit of Alcoa aluminum myself that as an equity that can't really get out of its own way also. So I would have expected, with all the uncertainty going on, that even the base metals would have had a bit of a rally, but not doing what I thought it would do. Anybody else? Anything else? We're getting a little late here. If there's anything in particular anybody else would like to look at. All right. Let me just give one more look-see at Aussie, my old friend Aussie. And again, with Aussie, the thing to look at is rate cuts. We've got China cutting and stimulating, and the Aussies are cutting rates. And you could tell the Aussie weakness in particular by Aussie Kiwi. Aussie Kiwi has fallen off a cliff. So the Australians are perceived to be cutting, and that's it shows it there. And if you look at it in the Aussie CAD as well, got a little bit of a hiccup here, which might mean that Aussie Kiwi's due for a bit of a reversal. But for now, the trend is really Aussie lower. If Aussie Kiwi were to back up, I think that would be more because of Kiwi selling than Aussie buying at this point. I want to look at dollar yen here. Dollar yen has been a bit of a safe haven the last couple of days. Again, we're back below 81.20 was an interesting level. Again, if we get below the 79, 80, 90 area, we could make a move all the way back down to 78.20, which was where we took off from. But there's no again, as we go more and more into safe haven mode, there's no benefit to to buying yen. The Japanese investors, they have what was moving dollar yen higher was, as the crisis was abating, the Japanese population, after Japanese year end, which was the end of March, decided to go out and start buying foreign assets again. Again, Japanese are very yield sensitive, and with European yields higher, they were buying European bonds. But again, with Europe imploding a bit, they're taking the money back on shore, and they're making a little money they're losing money on their bond positions, but they're making a touch of money on the currency exchange. But again, it's about principal preservation, not capital gains at this point. Let's take a look at Euro Sterling. Where is the Euro Sterling? There we go. Again, Euro Sterling. The Euro's lower, Euro Sterling's lower. It hasn't been running away. Again, if we look at the daily chart, if we're looking at it, we're pretty much 82.25 to 84 between friends over the last couple of months. And again, the bias here is Euro lower. Every time the Euro starts to get a bit of a move, they knock it back down. So, why fight the trend? Like we said, Sterling isn't going to be running away unless we can get, some sort of great news. I don't know what it would be that would make everybody start thinking that Spain and Italy were out of the woods, other than time. But for now, I think you got to go with the bias of Euro crosses a touch lower. And again, the only thing that'll change is if we get massive amounts of liquidity going in. Again, what saved the U.S. in their bailout was massive amounts of liquidity. The market is a one-trick pony at this point. If you throw in a ton of liquidity at Europe, the euro is going to rally. Okay, when it starts to dry up, or if it's been 2-3 months since the last round of liquidity, they're going to start selling it. That's all they look for. Again, with the quantitative easing that's been going on here in the U.S., the market is hungry for liquidity. As soon as they get a sniff of liquidity, they start buying the assets that the liquidity is going to, and that's it. It is as simple as that. That being said, I will wind up if there are no more questions. All right, let me tell you a little bit of who we are. Forex Folio. We are a group of market professionals who have been involved in Forex for many years. We have experience in customer service, trading, technology, algorithm / expert advisor writing, and we exist to serve our customers and help them with whatever needs they have to meet their financial goals. We have trading signals, we have virtual desktops, we have again an EA service where we will help you write an EA. We will sell you our custom EAs. We're willing to talk to you about any of these topics. We deal with most of the major brokers. Alpari is our preferred broker. We have a special rate category with Alpari that is extremely tight. We have relationships with FXDD and FXCM and Forex.com. If we don't have a relationship with the broker that you're looking for, let us know. I'm sure we know or have some contacts there, and we'd be happy to help you with any issues you might have getting your account set up or with any trades that you're questioning. We could be reached at our 800 number on the screen there, 1-800-756-7509. You can contact me via email at paul.spirgel@forexfolio.com. I welcome you to visit our website at www.forexfolio.com. You could Skype us at ForexFolio. Check us out on Facebook. We tweet regularly, and we post to YouTube as well. We strive to return messages within 24 hours. Any market questions or trading questions that you might have, we'd be happy to talk to you about. We do offer programming for MT4. We have a couple of dedicated programmers. If you give us a script of a program you would like written for MT4, we will, in contact with you, endeavor to write it to meet your specs. Again, we have reasonable rates for that. By all means, send us a message, and we'll be happy to discuss it with you. What else can I tell you about us? By all means, check out our website. We have offers coming and going on a regular basis that are there to help our clients take advantage of opportunities in the market. So on that note, I would like to thank our friends at FX Street for providing me with the opportunity to talk to you guys. I would like to thank you for joining me. I hope I was able to help and give you some insight into where I think trading is going to happen over the next couple of days. And good luck with your trading. And as always, feel free to send us a line if you have any questions. Keep well, and thank you for joining me.